This is a quick video recap of three major points from this course, Fundamentals of Corporate Finance Part 1. One thing I wanted to do up front is distinguish accounting from finance. Then one of the topics we covered in this course was forecasting, so I just want to walk you through a few key points on that. And a lot of the content in this course touched on working capital management, so I want to talk about some of the actual practices you would do to manage the working capital of the company. I want to make a few quick distinctions between accounting and finance, because a lot of people probably think accounting and finance are the same thing, which really is not true. Accounting, you process a bunch of transactions, that becomes the permanent historical record of the transaction, and the value doesn't change over time, so we'll call those constant dollars. So that becomes historical value in the world of accounting. In finance, you're not interested in maybe looking back in the past, you're looking ahead. So you're interested in what the values will be in the future. So accounting is processing all these transactions to generate financial statements. Then those financial statements kind of become the input into finance, where we're going to analyze things and forecast things. And then if you look at accounting, the emphasis seems to be on what the net income is or the profits, but people in finance, they're interested in the market value of a company or an entity. Accounting has a lot of rules you follow, generally accepted accounting principles, whereas finance, you're a little bit more creative in how you have to deal with the tasks that you need to deal with. Accounting is very iterative, month to month, quarter to quarter, year to year, so it's kind of a short-term focus. And finance is looking way out into the future, maybe a 5-year projection or a 1-year projection. So one of the concepts we talked about in this course was forecasting. And when you do forecasting, you want to start with the real driver behind the forecast, which is your sales volume. How much stuff do you plan on selling? And when you do a sales forecast, you want to look at, okay, how much capacity do I have? Because you can't just sell whatever the demand is in the marketplace. And you can look back. If it's a stable, mature company with an established market, then you can look back at what your historical sales have been. That quantitative analysis gives you insights into what's going to happen in the future. And then you want to couple that quantitative analysis with qualitative analysis and talk to some experts, because if you don't do that, your forecast could kind of be blown out of the water. For example, if people in marketing know that they're going to introduce new products and they're going to go after some new markets, that impacts your sales forecast. Or if there are patents expiring and all of a sudden intense competition is expected, that impacts your forecast. So don't forget to do some qualitative analysis and don't just crunch numbers based on the historical data. So once you get this real hard single driver, sales, from the sales forecast, then you can cascade that out, starting with the income statement for a forecasted income statement. And if you remember, if you took course 2 on financial analysis, we went through things like ratios and horizontal and vertical analysis. So if you have very good historical relationships in that analytical data, then you can really cascade and forecast your income statement. For example, in this example, if we have $100,000 of sales, and historically, okay, net income has been 12% of sales for the last 5 years, then you know pretty much your forecasted net income is going to be $12,000. Okay, so now that we have the sales forecast out of the way, we've gotten to a forecasted income statement. And that can lead us to the second financial statement, a forecasted balance sheet. So if you know you need to sell so much stuff and you've got a good forecast for that, how much assets are necessary to generate that revenue top line number, so you can generate a forecasted balance sheet. And it also gives you the indications of how much additional financing you might need. And then there you can carry that forward to a statement of cash flow, because you're going to have to service the interest on your debt, and that completes basically your complete set of forecasted financial statements. And one of the topics we talked about in this course was working capital management. I want to touch on 3 of those components, specifically cash, receivables, and inventory, starting with cash. So when you manage cash, you would want to collect the money owed to you as quickly as possible, and then you would want to pay the money out only when it is actually due. And when you consume lots of resources, you probably need a lot more flexibility in how you consume those resources. So maybe you don't need all of the people full-time, maybe you need more part-time people in the workforce, so you have flexibility in how you consume that resource. And you don't necessarily need to go out and buy everything. Maybe you can lease it, rent it. That saves a lot of cash flow. And if you have receivables, then you want to very aggressively manage those receivables, because that's where a lot of cash flow is tied up at. So when you manage receivables, then you want to be careful about who owes you money. I mean, if someone owes you money and they don't have the ability to pay you back, then you don't want to set up a receivable with that person. If you have risk like that, then you can kind of mitigate against that inability to pay you back. Maybe you can require them to advance some money to you, or give a deposit ahead of time to pay for the services. And obviously, we talked about it on the previous slide, that you have to aggressively manage your receivables, and there's certain controls you should have in place. Certainly an aging report of receivables should definitely be in place, and you can measure the effectiveness of your receivables through those ratios. And we talked about in the previous course 2 ratios, accounts receivable turnover ratio and the number of days held in receivables. And finally, inventories. Basically, you don't want to hold a lot of inventories. If you can minimally hold a certain level of inventory and meet your sales really well, maybe such as just-in-time inventory management. And if you have inventory items that aren't really moving, then you may have to move those inventory items much quicker by maybe even selling them at less than what you would like to. And similar to receivables, we can use ratios for managing inventory. Again, there's that inventory turnover ratio and how many days we held inventory. And if you have vendors and suppliers involved, it's a good idea to take a look at something called supply chain management to streamline the entire process.